One shot, one kill. Now that's a pretty bold name for a trading model, right? And in this video, we are going to break down exactly how it was used to pull off a near-perfect trade. Hey everyone, and welcome to AI Explains ICT. In this video, we're diving into the core content, specifically Month 7, Episode 8. We're going to get deep into the mechanics of a single high-probability setup, so you'll definitely want to grab something to take notes with. All right, let's just jump right in. Can you imagine calling your shot like this? Back in the last week of March 2017, ICT actually went public and outlined an expectation for the euro/dollar. He said he was expecting a high for the week right around 1.0908, and then a drop all the way to a weekly low of 1.0650. Think about that. That's a prediction for the entire weekly range, down to the pip, before it even happened. So, what happened? Well, take a look. The actual high of the week, 1.0909, that's just one single pip off. And the low, the market pushed down to 1.0655, only 5 pips away from the target. This right here is the kind of power we're talking about with the model we're about to deconstruct. So the big question is, how on earth is a forecast this precise even possible? Okay, so here's how we're going to break it all down. We've seen the mind-blowing prediction. Now we'll explain the OSOK model itself. Then we're going to walk step by step through all the layers of analysis, the macro environment, how the markets connect, and the super precise technical execution. And we'll wrap it all up with a final trader's checklist.
All right, first up, let's get into the framework behind this whole thing, the one-shot, one-kill model, or as we'll call it, OSOK.
So what is OSOK? Well, at its core, it's not about trying to find a dozen trades a week. It's actually the complete opposite. It's a really comprehensive system designed to layer multiple, totally separate forms of institutional analysis, one on top of the other, until the single, extremely high probability setup for the entire week just comes into focus. And, when we say layers, we really mean it. This is not about just looking at one or two indicators and calling it a day. The model pulls in everything, from the big 30,000-foot view, like macroeconomic conditions and historical seasonal patterns, all the way down to the nitty-gritty, like tracking institutional positioning with COT data and analyzing how related markets are behaving. It's all about building this top-down confluence of evidence. Okay, so let's see how this actually builds in practice. We're going to start at the very highest level, reading the macro environment to build a solid directional bias for the week. So, you've got all these different pieces of the puzzle. Where do you even begin? You can't just jump into a 5-minute chart, right? The analysis absolutely has to start from the top and work its way down. Well, it all starts with history. What you're looking at here is the seasonal tendency for the euro. Now, if you look at that highlighted area for March, you'll see this super clear pattern. The euro has a strong habit of rallying into the middle of the month, and then it declines pretty significantly. So the very first piece of our puzzle is purely statistical. History is telling us we should probably be looking for lower prices. But here's the thing. A seasonal tendency is just that, a tendency. It's a probability, not a guarantee. The crucial next step is we need to see if the actions of these smart money, the big institutional players, are actually aligning with this historical pattern. And this is where it gets really interesting. What we're looking at here is a classic divergence. On the top chart, you can see the euro's price making a new high. But look down at the chart below. This one tracks the positions of institutional commercial traders. While price was rallying, what were they doing? They weren't buying in. They were aggressively selling into that strength, going heavily net short. This is a massive red flag from the smart money, basically telling us they think the rally is overextended. They're positioning for a reversal, which, by the way, lines up perfectly with that bearish seasonal tendency we just saw. Okay, so now we have two really powerful macro clues, both pointing down. The next step is to confirm this idea by looking at other related markets. This is called intermarket analysis, because remember, the euro/dollar doesn't trade in a vacuum. Evidence piece number 1 comes from the US dollar index. This is simple logic. A stronger dollar is usually bearish for the euro/dollar pair. And what we see here is that the dollar index had traded right down to a major weekly support level. This is what ICT calls a discount area, a price zone that's cheap enough to attract those big institutional buyers. All the signs were pointing to the dollar being coiled and ready for a rally. And for our second piece of evidence, we need to confirm that the weakness was actually in the euro itself, and not just a story about dollar strength. So we look at this chart of the euro versus the British pound. And what do we see? Aggressive selling all week long. This tells us there was broad-based, cross-market selling pressure on the euro. It was weak everywhere. So let's just put the logic together, nice and simple. If the US dollar index is looking strong and ready to go higher, and the euro is simultaneously weak against other currencies like the pound, well, what does that imply for the euro dollar? The conclusion is pretty unavoidable. We have a strong bearish bias. Every single piece of high-level evidence is now pointing in the exact same direction. All right, with that rock-solid directional bias established, the analysis now shifts gears. We've figured out the why. Now it's time for the where and the when. It's time to drill down into the price chart to find those precise entry and exit points. Now, the plan isn't to just hit the sell button randomly. The whole idea is to sell at a high price, what we'd call a premium. For this particular setup, the target zone was a weekly bearish order block. Think of this as a high time frame level where we anticipate a ton of large institutional sell orders are just sitting and waiting. So the strategy was to be patient and just wait for the market to manufacture a little rally right up into this specific zone. Okay, now for the part that seems almost like magic, the incredible precision. How was that 1.0908 level identified so accurately? Well, it was done by measuring the intraday price swings on Monday. ICT talks about using a Fibonacci expansion, which is a tool that projects potential price targets based on prior swings. By applying it to the little retracement between the London and New York sessions, boom, it projected a high right at 1.0909. That Monday rally wasn't a sign of strength at all. It was a surgically precise move to tag a key sell level and trap unsuspecting retail buyers. And of course, every trade needs a target. If we're selling at a premium, we need to take our profits at a discount. The objective on the downside was a key liquidity pool, an area below some old lows where you can bet a large number of stop-loss orders are resting. Targeting this level down at 1.650 was the logical conclusion for the entire weekly move. And just like that, the whole trade, from entry to exit, is framed out. So, now that we've actually walked through a real-world example from start to finish, let's formalize this whole process into a repeatable procedure. You know, the best way to think about this isn't as some rigid set of rules you have to follow blindly. It's much more like a pilot's pre-flight checklist. Right? Before taking off, a pilot systematically checks every single critical component to make sure all the conditions are perfectly aligned for a successful flight. Trading should be no different. So here's that checklist, broken down into 5 key steps. First, you establish your directional bias. That's the big picture stuff, analyzing quarterly shifts, seasonal, COT data. Second, you identify your key price levels by mapping out those higher time frame PD arrays in premium and discount zones. Third, you anticipate the structure of the week itself. For example, are you expecting a Monday high of the week? Fourth, you frame the actual trade by finding a low-resistance liquidity run and confirming it with your intermarket analysis. And finally, step 5, you pinpoint your entry and exit using things like Fibonacci levels and intraday timing for that razor-sharp precision.
But listen, all of this analysis, all these checklists, they're completely useless without conviction. As ICT says, you have to come to a conclusion, and come hell or high water, stick to that until it no longer makes sense. That really makes you think, doesn't it? Is the biggest challenge for a trader really finding a model, or is it finding the discipline to actually follow it?
Well, that's a wrap. We really hope this deep dive into the one-shot, one-kill model was helpful for you. If you got some value out of this video, please do us a favor and hit that like button and subscribe to the channel so you don't miss the next one. And hey, if you have any questions at all, just drop them in the comments below and a real human will get back to you. Until next time, safe trading.